Silver is entering another period of institutional stress, and the latest development does not come from a bank, a mine, or a refinery, but from a regulatory desk in China. A new restriction announced by the Shanghai Futures Exchange has immediately altered the structure of participation in the silver futures market, and the timing of this decision has amplified its impact. It arrives not during calm conditions, but during a phase of elevated volatility, declining prices, and visible tension between physical and paper markets. The change is framed as a technical adjustment, yet it carries implications that extend well beyond the boundaries of one exchange. By limiting the size of opening positions, the exchange is directly intervening in how capital can be deployed, how risk can be accumulated, and how speculative exposure can be built. In a market already characterized by thin liquidity and sharp price swings, such interventions tend to reshape behavior rather than simply restrain it. This announcement also lands at a moment when silver is not trading as a unified global asset. Pricing signals from Asia and from Western markets are diverging, and the flow of metal between regions is no longer assumed to be frictionless. Against this backdrop, any regulatory shift in the world's most important physical demand center carries disproportionate weight, even if its formal scope appears limited to futures contracts. The immediate narrative around the decision emphasizes stability. The stated objective is to reduce excessive speculation and dampen volatility. However, history shows that markets under pressure often respond to constraints by redistributing activity rather than by reducing it. When participation is restricted in one venue, capital typically searches for another, and the resulting displacement can create new concentrations of risk. This is why the current development is not being interpreted merely as a domestic Chinese policy adjustment, but as a potential catalyst for broader market distortion. Silver's small market size, relative to other major commodities, makes it especially sensitive to regulatory and structural changes. Even modest shifts in positioning rules can generate outsized effects on price behavior and on trader psychology. In this environment, the restriction functions as both a signal and a test. It signals that Chinese authorities perceive the present dynamics as unstable enough to warrant direct intervention. At the same time, it tests the resilience of the global silver market's architecture and its ability to absorb regulatory shocks without transferring stress to other centers of trading. What follows from this decision will not be determined solely by its wording, but by how market participants adapt to it. The early phase is therefore less about the rule itself and more about the reactions it provokes, the channels it redirects, and the pressures it concentrates. The specific mechanism chosen by the Shanghai Futures Exchange is a reduction in the allowable opening position for silver futures contracts. Under the new rule, the limit is cut from 7,000 lots to 3,000 lots, with the change scheduled to take effect on January 19, 2026. This is not a marginal adjustment. It represents a material contraction in the amount of exposure that any single participant can initiate within the exchange. Position limits are one of the primary tools regulators use to shape market behavior. By capping the size of new positions, the exchange restricts how quickly large speculative bets can be built and how much leverage can be concentrated in a small number of accounts. In theory, this reduces the probability that aggressive trading strategies will destabilize prices through rapid accumulation or liquidation. In the context of silver, this lever is particularly powerful. The futures market is a central venue for price discovery, and the scale of participation is relatively small compared to more liquid commodities. A reduction of this magnitude therefore alters the balance between hedgers, speculators, and arbitrage participants in a way that is immediately felt in liquidity and depth. The effective date also matters. By setting a clear implementation point, the exchange creates a window in which market participants must adjust existing strategies, reconsider risk limits, and potentially reallocate exposure before the rule becomes binding. This transitional period can itself become a source of volatility, as positions are resized and trading activity is compressed into a shorter time frame. From a regulatory perspective, the measure is presented as a stabilizing action. From a market perspective, it is an explicit constraint on behavior. The distinction is important because constraints do not eliminate demand for exposure. They merely change where and how that demand is expressed. As a result, the reduction from 7,000 to 3,000 lots is not simply a numerical revision. It is a structural modification of participation capacity within the Shanghai silver futures market, and it sets the stage for a redistribution of speculative pressure across the broader global system. The stated rationale for this intervention centers on the need to curb speculation and reduce volatility in the silver market. According to the framework presented, recent price behavior has reflected levels of instability that are inconsistent with orderly trading conditions. By tightening the limits on how much exposure can be initiated, the exchange aims to moderate the intensity of short-term trading and to discourage excessive risk-taking. This objective cannot be separated from a second, closely related policy shift: China's new restrictions on the export of physical silver, which began on January 1, 2026. These measures directly affect the availability of metal to external markets and introduce additional friction into the global supply chain. When physical flows become constrained, futures markets often experience heightened sensitivity as financial claims and underlying material availability move further out of alignment. In this environment, speculative activity does not merely reflect price expectations, it also becomes a proxy for uncertainty about access, settlement, and delivery. Regulators, observing this dynamic, tend to interpret rising volatility as a symptom of systemic stress rather than as a normal function of market discovery. The combination of futures position limits and physical export controls therefore represents a coordinated attempt to reassert stability over both the financial and material dimensions of the silver market. One policy targets leverage and positioning, the other targets flow and availability. Together, they seek to dampen feedback loops that can amplify price movements beyond what authorities consider sustainable. However, these measures also introduce new constraints that participants must navigate. The effort to contain volatility in one segment of the market can, under certain conditions, displace it into another. This is especially relevant in a globally integrated commodity where pricing and liquidity are distributed across multiple exchanges and jurisdictions. The intention is equilibrium. The risk is fragmentation. How this balance evolves will depend on the degree to which these policies alter behavior rather than simply redirect it. From the perspective of the Shanghai Futures Exchange, the reduction in position limits is designed to stabilize its own market. By narrowing the capacity for large speculative trades, the exchange seeks to preserve orderly pricing and to prevent abrupt swings that could undermine confidence in the contract as a reliable pricing reference. Yet markets do not operate in isolation. When one venue becomes more restrictive, participants with unchanged risk appetite do not necessarily reduce activity. Instead, they often seek alternative platforms where constraints are less binding. In the case of silver, this introduces a critical dynamic, the potential redirection of speculative capital away from Shanghai and toward Western exchanges. This displacement effect is central to the current concern. Rather than eliminating speculative pressure, the rule change may redistribute it geographically. Liquidity that would have been expressed through the Shanghai contract can migrate to other futures markets, altering the balance of flows and the concentration of open interest elsewhere. Such shifts can carry unintended consequences. An exchange that absorbs an influx of speculative positioning may experience increased volatility, greater sensitivity to order flow, and heightened stress during periods of market adjustment. What appears as stabilization in one market can therefore translate into amplification in another. In this sense, the Shanghai decision functions less as a global dampener and more as a reconfiguration of where risk is held. The global silver market becomes more segmented, with different regulatory regimes shaping distinct pools of liquidity and speculation. The effectiveness of the policy, then, cannot be judged solely by conditions within China. It must be assessed in terms of how the overall system responds, and whether pressure is genuinely reduced or merely transferred. One of the primary destinations for any displaced speculative activity is the COMEX market. This is not a theoretical possibility, but a structural feature of global silver trading. The COMEX contract remains a central reference point for price formation in Western markets, and its capacity to absorb large volumes of financial positioning makes it a natural alternative when other venues impose tighter limits. At the time of this regulatory change, open interest on COMEX is already elevated, having risen by approximately 20% on a year-over-year basis. This expansion indicates that participation and leverage in the contract have been increasing, even before the impact of any redirection from Shanghai is fully realized. An influx of additional speculative positioning into an already crowded market can alter trading dynamics. Liquidity can become more sensitive to large orders, price movements can accelerate, and the margin for error in risk management narrows. Under such conditions, volatility is not necessarily reduced, it can intensify. The concern, therefore, is not simply that activity will move, but that it will concentrate. When constraints compress behavior in one part of the system, the remaining channels can experience disproportionate strain. This creates a situation in which the attempt to stabilize one exchange may contribute to instability in another. In practical terms, this means that the Shanghai restriction may shift the focal point of volatility rather than extinguish it. The COMEX market becomes the pressure valve through which global speculative demand is expressed. The result is a more uneven distribution of risk across the silver futures ecosystem, with implications for price behavior that extend well beyond the jurisdiction of any single regulator. Beyond the mechanics of futures positioning, the silver market is also defined by a growing divergence between regional price structures. The video highlights that silver is trading comfortably above $100 per ounce in China, while global spot prices remain in a significantly lower range, roughly between $80 and $89 per ounce. This discrepancy is not a minor arbitrage gap. It represents a visible dislocation between Eastern and Western valuations of the same underlying metal. Such a spread alters incentives, expectations, and perceptions across the market. For participants in China, elevated prices reinforce the sense that silver is scarce and that access carries a premium. For participants in Western markets, lower quoted prices may mask underlying tightness in physical availability and distort assessments of risk and value. When regulatory measures are introduced into an environment already characterized by such divergence, their signaling effect becomes as important as their mechanical effect. The restriction on positioning communicates that authorities recognize instability, even as price levels differ sharply by region. This disconnect also complicates the goal of equilibrium. A market cannot be considered balanced when its primary trading centers reflect materially different price realities. Under these conditions, regulatory action in one region may be interpreted not as normalization, but as confirmation that existing imbalances are structural rather than temporary. The East-West split, therefore, is not merely a backdrop. It is an active force shaping how the new restrictions are understood and how market behavior evolves in response. The immediate trading environment in which these measures are being introduced is not one of strength, but of retreat. At the time of the discussion, silver is down by more than 3%, reflecting a broader downturn that has weighed on sentiment across the market. Price declines of this magnitude, when combined with rising regulatory intervention, create a complex psychological setting. On one hand, falling prices can reduce speculative enthusiasm. On the other, they can heighten sensitivity to policy changes, as participants reassess risk and positioning under less favorable conditions. Restrictions imposed during a downturn carry a different impact than those introduced during a rally. They are more likely to be interpreted as defensive actions, aimed at containing instability rather than guiding orderly expansion. This perception can influence behavior even more strongly than the formal content of the rule. In such an environment, measures intended to calm markets can instead interact with negative momentum, amplifying uncertainty. Participants may respond not by reducing exposure, but by accelerating adjustments, compressing decision-making into shorter timeframes, and increasing the intensity of short-term moves. The result is a market that is simultaneously constrained and reactive. Stability becomes harder to achieve, not because of the absence of rules, but because of the interaction between falling prices and tightening controls. This backdrop is critical to understanding how the Shanghai restriction may function in practice, as it collides with sentiment already shaped by weakness and volatility. Despite the immediate weakness, the speaker's interpretation is that the new restrictions carry the potential to produce the opposite of their intended effect. Rather than suppressing prices, they may contribute to a behavioral response that drives them higher. The logic presented is rooted in market psychology. When access is constrained and participation is limited, uncertainty about future availability can intensify. In such conditions, participants may seek to secure exposure preemptively, not because conditions have improved, but because they fear further restriction. This dynamic is described as panic buying. It is not driven by new information about supply or demand, but by the perception that the rules of engagement are changing. The restriction itself becomes the catalyst. Under this framework, the attempt to impose equilibrium can generate instability by accelerating demand for positions and for physical exposure before constraints tighten further. The result is upward pressure on price, even in the absence of a positive fundamental shift. The speaker suggests that this process could catapult silver toward the $100 level. The target is not presented as a technical forecast, but as a plausible outcome of how markets respond to regulatory compression under conditions of underlying stress. In this sense, the restriction is seen less as a brake on the market and more as a trigger. It transforms concern into action and caution into urgency. The conclusion drawn from this sequence of events is that while authorities may seek equilibrium, the structure of the silver market makes such balance difficult to sustain. The regulatory objective is stability, but the conditions described point toward persistence of elevated prices rather than a return to subdued ranges. Two forces are emphasized in this assessment. The first is the presence of a structural deficit in silver, which limits the market's capacity to absorb rising demand without significant price adjustment. The second is the influence of underlying inflation, which continues to shape the nominal valuation of real assets. Together, these elements suggest that regulatory measures can moderate the path of price movement, but are unlikely to reverse its broader direction. Constraints on positioning and exports may alter the tempo of the market, but they do not eliminate the pressures embedded within it. The implication is not that volatility will disappear, but that it will persist within a higher price environment. Efforts to suppress instability may simply reshape its expression, shifting where and how it emerges rather than resolving its cause. In this framework, the Shanghai restriction becomes part of a larger narrative. It is one intervention among many in a market that is structurally tight and monetarily stressed. The pursuit of equilibrium, therefore, coexists with the reality of sustained elevation. The silver market remains defined not by the absence of control, but by the limits of what control can achieve. This sequence brings the analysis back to the central tension identified throughout the discussion. The market desires balance, and regulators design tools to enforce it. Yet the silver market, as it is currently structured, responds to pressure in ways that are often nonlinear and difficult to contain. The restriction imposed by the Shanghai Futures Exchange is emblematic of this challenge. It is precise, targeted, and rational within its stated objective. At the same time, its effects propagate beyond the boundaries of the exchange, interacting with existing price divergence, shifting speculative flows, and heightened sensitivity to policy change. What emerges is not a simple story of stabilization, but one of redistribution. Risk is not eliminated, it is relocated. Volatility is not extinguished, it is reframed. The regulatory action becomes part of the market's narrative, influencing expectations and behavior as much as mechanics. In this context, elevated prices are not an anomaly, but a reflection of deeper structural conditions. Interventions may shape the trajectory, but they do not reset the underlying environment. The silver market therefore remains in a state of managed tension. Equilibrium is the goal, but persistence of stress is the reality. The Shanghai restriction stands as a clear signal of that reality, and as a reminder that in tightly constrained systems, control and instability often advance together.